Hey there, it's Tom Ryan, founder and CEO of ICR. Before we get into the next episode, I wanted to ask that you subscribe to the show. It'll help us get even more unique and interesting guests on the podcast and in turn continue to educate management teams and the growing ecosystem that creates value for fast-growing private and public companies. And while you're at it, head over to Apple Podcasts and leave us a 5-star rating. Very much appreciated.
We go and acquire existing producing wells. So as the industry continues to kind of drill out their inventory, it creates additional runway for us over the next 3, 5, 10 years to continue to grow through our acquisitions.
For most companies, drilling new wells is a major part of the business strategy, but today's company is taking a very different tact.
We are the first public company with this strategy, which is really just a pure play cash flow from existing operations and generate additional income out of efficiencies from the assets rather than drilling.
My name is Tom Ryan, and this is Welcome to the Arena, the ICR podcast. Each week, I sit down with today's business leaders to give you an inside scoop on some of America's most prosperous public companies, their origins, their challenges, and the keys to their success. Today's guest is Will Ulrich, co-CEO of Presidio. Will has served as co-CEO since founding the company in 2017, along with his partner, Chris Hammack. He has over 15 years of energy experience and is focused on using technology and best practices to drive behavioral change in the oil patch. Will graduated from Harvard with a degree in economics and began his career as a banker. But his mission now is to generate the oil industry's best returns on capital by delivering the industry's lowest operating expenses, highest profitability, and best emissions profile. Let's enter the arena with Will Ulrich. As I said in my introduction, you've been in the industry for 15 years or so. What did you and Chris, your co-founder, see in the marketplace like in 2016 where you looked at each other and said, like, we're going for this, we're going to do it?
Yeah, so Chris and I were friends for a while. And in 2016, the industry was going through a real downturn. It was not a pleasant place to be. And he and I had always talked about starting a business together. And we thought that it was a good time to go and do it. And we started with a really blank piece of paper.
Yeah.
And we looked up and down the value chain and where people were investing their capital in oil and gas at that time was mainly in what I call more venture capital. So it was developing undeveloped properties. It was buying acreage in areas and testing it, trying to prove out new concepts for drilling and for development, and then selling those businesses to larger companies once they were proven out. And the prices as a result, because that was where 95% of the capital was flowing, pricing in that area was really bid up. And honestly, there were just a lot of things that had to go right in order for that strategy to work. And Chris and I tend to come at things with a bit of a contrarian angle, was to say, let's go into that area where only 5% of the people are looking.
Yeah.
And let's go discover some real value and see what we can do in terms of building a strategy that generates long-term value consistently and frankly doesn't rely on the drilling that most of our business relies on to make money.
Yeah.
And so as a result, we ended up targeting just existing cash flowing properties starting in 2018, but then over the next several years, in conjunction with our partners at Morgan Stanley, we put, I think, over $600 million to work buying cash flow and buying these producing oil and gas properties at relatively attractive valuations. But the way that we really outperformed the market was through our secret sauce, which is the extreme optimization of those wells.
Yeah.
And so we were able to go and make the production more efficient, as well as cut operating expenses from the acquired properties by 50, 60, 70% within a relatively short period of time, which is what really enabled us to outperform as a private company over the last 7 years here.
Yeah, you're like in a totally different business, right? I mean, it's just not with the drilling and the infrastructure and the risk and all that.
Correct. Yeah, Presidio has never drilled an oil and gas well. We have no intentions to drill an oil and gas well. And yet we've been able to generate the industry's leading returns over the last 7 years here. And so it's an exciting value proposition. It's been an incredibly successful private company. And then through this combination with EQV, we had the opportunity to take the business public and to expand the story into broader markets. And so we're really excited about that.
Yeah, so let's talk about that. EQV Venture Acquisition Corp, taking you public. They have experience in oil and gas assets as well. Maybe talk a little bit about why they're a good fit. What do they bring to the table? And kind of pro forma, what does this thing look like?
Yeah, they do have similar backgrounds, actually, which is great. So they raised their SPAC back in the summer of 2024, and we almost immediately started talking to them as we knew that the long-term vision for this business was to get it public. We wanted to have access to permanent capital. It's such a unique story, and the business model provides a real differentiated value proposition for investors, but in addition to the potential for long-term equity appreciation, which we've been able to generate as a private company, but also in particular for public investors, we offer a steady income from a yield. And so when we looked at going public, the traditional IPO route has been a challenging one for energy companies over the last several years, just not companies in our business model, but companies in the standard kind of drilling and development model have underperformed the market and have created a situation where there's not a lot of appetite for new issues. And in fact, at the same time, it's really the opposite. So there's been a significant amount of mergers within the public space, and public companies within oil and gas are going away.
Yeah.
And so we've lost, I think, 30% of public companies in the oil and gas space over the last few years.
Yeah.
But we did want to take the company public, and the way to do it was we thought, the best execution was going to come through the guys at the SPAC.
Where are you regionally? Where are the wells? How many are you going to kind of have off the bat when the deal is closed?
Yeah, we operate over 2,000 wells, mainly in Texas and Oklahoma. The area of our world is called the Anadarko Basin, and specifically we're generally in the western Anadarko Basin. We're very much a consolidation and acquisition growth story. So this is a roll-up strategy, and we'll be looking, across Texas, Oklahoma, Arkansas, Louisiana, those areas for additional acquisition opportunities.
Yeah. I know the investor materials you say, which I thought was a great quote, as the capital-intensive shale era gives way to a more disciplined focus on returns. I mean, is this like a industry-wide mindset, or is it kind of a very small group, namely you guys, kind of doing something like this?
Yeah, we were the first business to pursue this strategy privately. There has been other capital that's been raised and other competitors who really were created after Presidio came out and started making our first acquisitions. Now we are the first public company with this strategy, which is really just a pure play cash flow from existing operations and generate additional income out of efficiencies from the assets rather than drilling. But the reality is, when you look at the energy landscape today, we've had such success growing production domestically, and you hear about that all the time, that the U.S. is now, one of the largest producers of both oil and natural gas in the world, which really creates incredible strength for us, but also has resulted in the consumption of a lot of those drilling locations. And so, the more undeveloped locations that turn into developed locations, it's a major issue for the industry right now, and everybody talks about their lack of inventory and economic wells and what the kind of number of years of inventory are that are left over for additional growth. That issue for the industry is exactly the inverse to us and is a benefit to us, which is, as they develop those assets, it becomes feedstock for our acquisition platform where we go and acquire existing producing wells. So as the industry continues to kind of drill out their inventory, it creates additional runway for us over the next 3, 5, 10 years to continue to grow through our acquisitions.
So, there are a lot of investors that understand that are kind of part of this transaction. JP Morgan Investment Management, I know, major oil and gas company. Talk about that level of institutional backing and kind of what it says about the path that you're on.
Yeah. When we announced the deal, we wanted it not to be just a kind of unfunded SPAC transaction where, we were going to go out and market and try to, get the money in trust after we announced it. We wanted to announce a deal that was really, quote unquote, fully financed, where we could show a real pathway towards, being able to close and have a well-capitalized business at closing without having to rely on much of that cash and trust. And so we were successful in raising an $85 million pipe. We had BP in that common equity, as well as other high-quality institutions. We raised preferred equity, to your point, from JP Morgan Investment Management. We have a standby credit facility from Citizens Bank, and then we're leaving our existing investment-grade bonds outstanding, which are owned by various insurance companies and pension funds. So, the company will be incredibly well capitalized at closing and allow us to go and execute on the acquisition growth story kind of right off the bat.
Yeah, I think another thing for listeners here to keep in mind that I thought was really notable, Presidio Management and Morgan Stanley Energy Partners, who I think was like your original backing,
Yes.
are rolling equity here. It's not like everyone's cashing out and it's over.
Yeah, in fact, Morgan Stanley they'll roll about 20% of their stake in the company and cash out the balance, but management, we're rolling 100% of the equity that we own in the private company into the public business.
Yeah. Maybe the most underappreciated part of the transaction from what I could see is the projected 13.5% dividend yield. Growing up following stocks, I was a sell-side analyst for a while. When you get above 5 or 6 or 7%, that kind of means that no one believes you can sustain it.
Right.
This is completely different. Why don't you talk about your philosophy on the dividend and its sustainability over time?
Yeah, we're the first de-SPAC transaction in nearly a decade that will have a day one cash dividend. So we're excited to bring that kind of differentiation to the market.
Yeah.
The 13%, is really, if you think about where the peers trade, is more like in the high single digit type yields.
Yeah.
And the 13% kind of represents our quote unquote IPO discount in getting the business public. And so I do think that there will be, as we mature as a public company, room for compression around that dividend yield.
Yeah.
But what we wanted to do was pay out an attractive dividend that would bring people into the name. Over time, we would love for there to be a strong retail following in the stock, whereas right now we're, almost 100% institutional and insiders. But I think that dividend yield should be attractive. And as we get research coverage picked up, et cetera, after closing, I think people will start to see more of the story and understand why they should invest. But the $1.35 is a fixed dividend. We demonstrate in our projections that just based on our existing assets, we can show, clear line of sight for investors to be paid that for years. But this is very much a dividend growth story. And so as we think about how we're going to grow that dividend, we're going to grow it through acquiring additional properties that are in and around the assets that we already own, and then potentially in some other new basins as well. And you can see the dividend growth because we're starting as a relatively small business that will emerge as a $700-ish million enterprise value. Adding $200 or $300 million of M&A onto our balance sheet provides a real opportunity to step that dividend up fairly significantly. And in fact, if you look at our investor materials, we show doing $200 million of acquisitions in our first year, $300 in our second year, $400 in our third year. And through that, we're actually able to increase the dividend by more than double in the projections up to $2.77. So, the 13% yield on the current assets is, I think trading at a discount to where the peers trade and to where we would trade as kind of a mature public business. But then once you build in the acquisition growth, which we are highly confident in being able to go and execute well on, it's our bread and butter, it's what we do.
You've done it.
Yeah, we've done it.
It's not just words, right?
Yeah, exactly. It's a 28% yield on a dividend 2 years from now. So we're pretty excited about that. And to your point on, management being invested in the business, we'll be large shareholders and feel like we're very aligned with all new shareholders who are coming in wanting to, increase that dividend over time, but then also generate real long-term equity returns in excess of our cost of capital. And as a result, have a, long-term appreciation story.
It's like really unique. It's very impressive. When you talk about your total addressable market, I know one of the things that was interesting to me is how much money was deployed, particularly by private equity in a lot of these assets. And the clock is ticking, in terms of all the LPs want to turn that capital and get their money back. Talk about kind of that, your TAM and private equity, how it played out over the last several years, which I have to think you and Chris saw when you were forming this whole thing.
Yeah, and honestly, we're a great example of it. So our partners at Morgan Stanley Energy Partners who backed us and provided in large part the equity capital for us to grow through acquisitions. That was I think 2016 vintage fund. And so, they were in year 9 of the fund and were, selling off portfolio companies and needing liquidity. And so we were able to get them, that liquidity through the SPAC transaction here. But in general, in 2016 and in that era, there was probably at any given time $100 to $150 billion of equity raised for energy private equity, just massive amounts of money that really is what funded, this massive production growth that we've, experienced here in the U.S. And once we ran into kind of two issues as an industry. One, a lot of that development ended up, while it did increase production, it didn't create production at rates of return that were attractive to investors. And then secondly, ESG became a much bigger factor in creating headwinds, for oil and gas in general in that time period. So that, $100 to $150 billion pool of capital has subsequently shrunk. And today, there's maybe $20 billion, of which half of that is tied up with one private equity fund. There are just a handful of guys who are left standing who have been able to continue to raise equity capital in the energy space and get backing from those LPs. The other guys have existing investments and assets and things that they're managing, but they haven't been able to raise additional capital. So if you look at what their outcomes are, they can put assets or companies into continuation vehicles. They can take companies public. They
can only do that for so long. Well, the continuation, at some point you need liquidity.
Yeah, exactly. And so the exciting thing for us is, number one, just my point earlier that as assets become more and more developed, it enters our wheelhouse for the type of asset that we want to buy. And so our, that total addressable market, we think, is probably in the $75 billion range of, assets in general over the next 5 years. And, maybe 40 billion of that, are things that are really in our wheelhouse that we think will come out in the next few years. And if you keep going down, probably 15 billion is stuff that we'll be looking at over the next 12 months. So the market is really quite large. And then our unique proposition for the private equity sellers is, we're happy to offer cash for the acquisitions, but also if they're interested, we can offer equity. And so they can take back equity. They can continue to participate in those assets as well as, the broader assets that we own, continue to get exposure to commodities and other things that they might be looking for, while at the same time, being able to get some liquidity on the investment.
So we've covered the company's background and total addressable market, but a big part of Presidio's success comes from their ability to drastically reduce operating costs on existing wells. I asked Will to explain their strategy behind that and how they actually achieve those reductions.
If you think about our acquisition economics, the reason why this is compelling and another real differentiator from other competitors is there's nobody else who does this kind of at the scale and with the consistency that we do. But, the market rate for acquiring assets in today's market is probably a kind of 12 to 15% unlevered return. And then, add some modest leverage and, you'll increase that 2 or 3%. So, you're looking at kind of mid to high teens type returns levered from these assets. What we do with our value proposition with being able to cut that operating expense, where in any deal that we look at, there are going to be savings, and they probably range from 35% at the lowest level up to, if it's an asset directly offsetting areas that we currently operate in, maybe 80% type cost cuts.
Yeah.
That's going to lift up that mid to high teens well into the 20s type levered equity returns. And so that is where we think that in addition to these assets being able to be kind of dividend accretive on day one, the fact that we're able to invest that equity capital into the 20% type returns and our public equity cost is probably in the 10 to 12% range, would suggest that over the long period, we're going to see some nice appreciation in the equity value. The way we do it, there's a lot that goes into it. It's a lot of little things, but the overarching thing is our culture. So we operate very differently than any other oil and gas company. For the most part, oil and gas companies are operated in command and control structures. And so you'll have an engineer who's in Fort Worth or Dallas or Houston or Oklahoma City who's effectively kind of dictating to the field, how they should be operating their assets.
Yeah.
We disintermediated that entirely. So, our goal is to push decision-making down as far as possible in the organization. And so for us, our key decision maker is a man or woman who's driving around in a pickup truck and operating, a set of 40 or 50 or 60 oil and gas wells in his area in the Texas Panhandle or in Western Oklahoma. And so what we realized we had to do with those in order to empower those guys to make good decisions was to provide them with a lot of information, probably more than they've ever seen in their careers, to distill it in ways that enable them to make effective decisions, where we have built proprietary tech and things that allow them to really understand what's going on in their business. And it is their business. We call them small business owners. And, their job is to generate more profitability out of their small business than we've budgeted for. And to the extent that they achieve those goals or achieve things that, they're setting for themselves or improve profitability or improve cash flow on their small business, we'll pay them back a portion of what they create through a field incentive plan, giving them the opportunity to double their annual incentive income through that. So, we've kind of taken the way that the industry has operated for a long time, and we've flipped it on its head. And in a lot of ways, it's kind of back to a pre-shale mentality, when it was really about just being the most efficient operator as opposed to, drilling the most wells and increasing production the most.
I have to think the person that you just described who's kind of managing 40 or 60 wells or whatever has to be like so incredibly important. And, I would imagine there's competition for that person. And I think it's worth just reiterating, these people can have life-changing differences in their compensation, participate in the upside.
Yeah.
And that's how you get the best of the best, right?
Yeah, we love our field guys. My business partner, Chris, started his career as a field guy, and so he always has a strong kinship with them. I have a lot of respect for the hard work that those guys do. We try to go above and beyond wherever we can. In addition to the field incentive plan, we pay for 100% of their healthcare costs and try to create a real environment where they feel like they're empowered to go and make good decisions, and where they have the information to go and make good decisions, and then where they get kind of the full feedback on that is they then get rewarded to the extent that they're able to. We call it our TCB, which is taking care of business. That's the field motto.
I love it.
And everybody's really bought in.
It's like Elvis.
It is. That's where we stole it from Elvis. Yeah.
With the lightning bolt coming through it. I love it.
Yep. It's all around our office. You'll see TCB with the lightning bolt all over here.
You got to get some swag going there, right? Unless you've got to pay the king's estate for that.
That's right.
So you're projecting a low production decline rate of 8% versus 24% peer average, which is amazing. What factors contribute to that kind of stability, and why is that so important for investors to understand?
Yeah, so it's really the business model is driving that. So if you are an active development company and so you're drilling new wells decline at much higher rates than older wells. And so the average well in our portfolio today is probably about 15 years old, which means it's been producing for a while, which means a few things. One, it's out of that high decline phase, so it's into this kind of 8% or less exponential decline. Two, it's easily predictable. And so at this time in a well's life, there's really no debate about what it's going to produce next month or next year or in 5 years from now. You can really plot it out. It's physics, and our engineers do a good job with that. And then it's obviously audited by third-party engineers. But for us as a dividend company, it's important because that's what provides the stability around being able to pay this dividend to investors that is consistent and steady for the foreseeable future here. And then will give us the cost of capital advantage as a result to be able to go and make those accretive acquisitions.
Yeah. And then I read that I think 78%, I'm a PR guy, I'd round that to 80, of your estimated production is hedged through 27. How does that support the business model and the dividend plan? And how do you approach hedging beyond 27?
Yeah, so we continue to hedge out through 2031. So the way that we operate our business thematically is to put in place long-term hedging when we acquire an asset, which tends to be probably 80 to 85% of the production for 5 to 7 years.
Yeah.
And so we want to protect the payback period on the acquisition economics. We want to protect the dividend during those years. We want to protect ourselves from any sort of volatility around commodity prices, any issues around leverage. We want to be conservative around leverage and use hedges to protect ourselves to the extent that pricing goes down. And so we have flexed in, I think, some of our investor materials basically showing, the impact of 25% reductions in commodity prices. And, we're still able to pay that dividend with coverage on it because of that hedge profile. And that's something we'll continue to do on a go-forward basis, is to use hedging to mitigate risks around the commodity. This has always been a volatile industry. It's known as a boom and bust industry.
Yeah.
And we have wanted to kind of smooth out that boom and bust. And so that's why we don't participate in drilling wells. That's why we use this conservative hedging approach, use conservative leverage, et cetera. Because, our opinion is that when commodity prices are high, that's great. We'll figure out how to make more money in that situation, even though we're hedged. And then when commodity prices are low, not only are we protecting our business, but we're making sure that we're in business so that we can go make those good acquisitions that happen once, other people start to feel the pain from that volatility.
Yeah. I think another strength you have, and correct me if I'm wrong, 3% of revenue is CapEx.
Yeah.
I mean, that's like extraordinary.
I mean, the reality is that that number on our assets is really zero in terms of CapEx. The 3% we're reinvesting is we tend to buy in some of our third-party services where it makes sense economically to do so, and that's what we spend our CapEx on. If you look at kind of how this comps out versus, peers or at least other oil and gas companies, people who are in that development mindset are probably reinvesting, 80 to 100% of their free cash flow into new development. There's another kind of subsector of guys who are focused on cash flow and production, similar to how we are, less focused on efficiency, and they have some drilling. And so they're maybe investing 20 to 40% of their free cash flow into development. And then you have Presidio where it is zero. We do not drill. We think the economics for us are way better to go and acquire assets and improve those assets rather than creating new oil out of the ground.
You're just like so different than what people normally think of. Hey, I'm going to allocate something into this industry, but you're like totally different. Yeah,
it's a differentiated story. One of the investors who we met with recently remarked that it was unknown and uncovered. Yeah. And as a result, he was a strong buy.
Big time.
Because I think it's fundamentally different than what other people are doing. We have a proven track record of generating the best returns in the industry as a private company, and now we have an opportunity to take that into the public markets.
And then obviously you mentioned the balance sheet and maintaining a low leverage ratio, I think slightly over 2. Mm-hmm. That helps you with the acquisition strategy. And we talked about the TAM, but what specific criteria, in as much as you can share it, do you look at when you're looking at, maybe you have 20 opportunities? How do you prioritize the funnel?
Yeah, so we tend to look at a matrix where we look at things that are widely marketed versus negotiated, and then highly actionable versus less actionable, and kind of put things into their respective box and focus on the things that are actionable. Almost every asset today is getting marketed by a bank in the industry. That's just become the standard thing to do. We've been successful in navigating those auctions. We tend to know, where the market prices are for these various assets. But a new opportunity comes across the transom. We look at it for, first of all, is it a cash flow asset, not a development asset? And then obviously we'll cast aside the development assets. But of those cash flow assets, is it have a decline rate that's commensurate with what we have as our existing business? So in terms of asset quality, is it kind of neutral or accretive to what we have? Is it in an area where we have good access to being able to sell the oil and natural gas without a lot of volatility in local pricing? And then importantly, is it a type of asset where we think we have an opportunity to come in and really make it more efficient because it's being operated by a seller who we know and who we know could be improved on, or maybe it's being operated by somebody who is just focused on drilling new wells, and so they're not focused on the optimization of their existing production. How compelling is that story? And that'll kind of inform how much time we should spend on it.
Yeah. Looking out 5 years, Will, and without getting into numbers or anything, but what do you kind of envision for Presidio in terms of like scale and geographic footprint and general returns for shareholders?
Yeah, and I'm happy to throw out numbers because
whatever you want.
I like big numbers.
Yep.
My goal as this U.S. oil and gas industry matures and things become more and more production heavy and less development heavy, that we are known as the consolidator of those assets. I look back to companies like XTO and others who started at kind of the size that we are and then eventually became $40 billion businesses. And that would be something that would be an attractive path for us. So my near-term target is to essentially 10x our EBITDA from the $115 million we have today to over $1 billion. That would be through, making accretive acquisitions that we're able to generate significant returns in excess of our cost of capital. I'd like to see, the dividend get up into that targeted high 2s up to $3 a share, and enjoy kind of the commensurate trading premium that I think we'll get from being able to grow the business like that.
That was Will Ulrich, founder and co-CEO of Presidio, which will trade under the symbol FTW upon the closing of the transaction with EQV. Presidio is a differentiated oil and gas operator in that they're focused on optimizing mature producing oil and natural gas assets in the U.S. versus drilling. Their intent is to continue to acquire wells, bring technology to the table, including automation, real-time analytics, and AI, so they can make smart decisions on the ground. All of this controls costs and risks and allows them numerous levers to create value for shareholders, including what is likely an underappreciated 13.5% dividend at $10 per share at close. I'm Tom Ryan. We'll see you next time back in the arena.
References to specific stocks are not intended to be recommendations for specific trading behavior. Comments presented on this podcast are intended for informational and educational purposes only, and do not represent opinions or recommendations on whether to buy, sell, or hold shares of a particular stock. All investors are advised to conduct their own independent research into individual stocks before making a trading decision. In addition, investors are advised that past stock performance is no guarantee of future price performance.